Hi, this is Dan Collins, Editor-in-Chief of Modern Trader Magazine, coming to you live from the floor of CME Group on December 17th for Traders Exclusive. I have a little bit of a cold, so I apologize for my voice. But maybe it was about screaming that the Fed finally did it after years and years of zero rate policy, after a year and a half of hemming and hawing about when they're going to do it. They did it, finally. They raised short-term Fed funds interest rate 25 basis points. The target is now 1/4 to 0.5%. The market reacted well. Let's face it, this was a done deal. We all knew it, so there should have been no market reaction, though there was a little volatility. And globally, it was taken well because I think just about everybody knew it was time. And one might think that all the controversy is over now. But not quite, because if you listen to Janet Yellen's testimony or her press conference, she talked about the median range, the dot plot that all the Fed governors put out, and that for next year, for the end of 2016, is at 1.37%. Now, if you heard me last time I spoke on the subject and it looked at the website futuresbag.com, you know that currently the Fed fund interest rates, futures, are pricing in only 50 basis points of additional tightening for the entire year of 2016. I think the January 2017 contract is trading at 99.14, which would indicate that rates would be between 75 and 100, which would just be an additional 50 basis points. So that's a big dichotomy. Obviously, what's going to drive what happens is going to be inflation figures. That's what's been lagging. That's what's allowed the Fed to hold back, even though they originally talked about unemployment at 6.4% before they moved. So there is more, there is more mystery out there because of the pace. Yellen said that everything that she'd be very transparent, but it's not necessarily going to be an even time. It's not necessarily going to be even paced. I may anticipate a surprise next year, maybe them locking in a rate when they get closer to 1%, so we're not in this range anymore. One other interesting note happened yesterday. If you were too focused in on the Fed, you might have missed it, and that is the lifting of the U.S. crude oil ban. Kind of a non-event, but this is a huge thing. This ban has been around since 1973, since OPEC embargo pushed prices up in 1973. Couple interesting things. It may help stop some certain disruptions. I don't know if it's going to help exporters so much, but a lot of the question with crude oil has to do with the refineries and too much of the ultra clean fracking oil and not enough of the dirty oil that the refiners are geared to do. So that might smooth spikes in the transport of oil. Probably not a big deal, but OPEC did not say anything dramatic in its recently concluded meetings in December. Some people say, well, that's a sign of OPEC weakness. But if you look at futuresbag.com, we've got an interesting perspective from Ellen Wald, very expert on Saudi Arabia and OPEC that covers this a lot, saying it's actually a sign of strength because they can maintain lower oil prices. If they were in trouble, they probably want to cut production so to force prices up. But as Saudi Arabia seemed to be saying all along, they're the low-cost producer, so they can afford to sit and pump oil at these prices more than anybody else in the world. For those waiting on a bottom, in a couple hours, I'll put something up on futuresbag.com. Interesting technical studies that may indicate that yes, the bottom may be near. This has been Dan Collins, Editor-in-Chief of Modern Trader Magazine for Traders Exclusive. See you next time.